Welcome. If you just typed real estate versus stocks, what is better, detailed video into your search bar, well, you're in exactly the right place. Today, we're diving straight into the ultimate age-old debate, real estate versus the stock market. We're going to break down the cold, hard facts, completely impartially, so you can figure out exactly where to park your hard-earned money and actually build that financial future. Let's get right into it.
All right, here's our game plan for this heavyweight bout. We'll start with the ultimate investing showdown, explore building tangible wealth with real estate, and then shift to liquid assets in the stock market. We'll also check out a hybrid option, REITs, before jumping into the historical return showdown, and finally, figuring out which is actually better for you.
So, which one actually makes more money over time? I mean, it's the single biggest question every investor asks, right? But as you'll see throughout this explainer, the answer is definitely not a simple one-size-fits-all number. It honestly depends entirely on your personal risk tolerance, your budget, and, well, your unique investing style.
Okay, Section 1, the ultimate investing showdown. Because, before we can even try to pick a winner here, we really need to understand exactly how these two totally distinct asset classes actually build wealth in the first place.
Now, the absolute game changer here, it's leverage. See, when you buy stocks with, let's say, $25,000, you generally just buy exactly $25,000 worth of shares. Simple, right? But real estate operates on a totally different wavelength. That exact same 25 grand can act as a 20% down payment on a $125,000 property. You're essentially using the bank's money to magnify your potential returns. It's wild. You get to control this massive appreciating asset using only a fraction of the upfront cash.
Moving right along to Section 2, tangible wealth, real estate. Let's step into the ring with our first contender and really explore the everyday realities of building physical property wealth.
Look, there is a massive reason so many investors absolutely love property. It's concrete. I mean, you can physically touch it, you can walk through it, and for a lot of people, that just makes it inherently easier to wrap your head around than some digital ticker symbol flashing on a screen. Plus, it historically acts as a fantastic hedge against inflation, mainly because property values and rental incomes generally creep up right alongside the cost of living. And we cannot forget the tax advantages. They're incredible. You can legally deduct mortgage interest, property taxes, operating expenses, and get this, even property depreciation, all to lower your overall tax bill.
But wait, before you go out and buy an apartment building, remember that real estate is definitely not a magic bullet. It demands serious physical sweat equity. You're managing tenants, you're maintaining a physical structure, and yeah, you're dealing with the very harsh reality of unclogging a broken toilet at 2 a.m. It's also highly illiquid. You literally cannot just cash in a house overnight if an emergency pops up. Add to that the painfully high transaction costs, we're talking brokerage fees, legal fees, stamp duty, and the massive chunk of upfront capital required, which makes it incredibly difficult to diversify your portfolio compared to just buying stocks.
So, to mitigate those exact headaches and actually ensure some profitability, savvy investors often lean on strict guidelines like the 1% rule. This is basically a crucial financial safeguard. It works like this. If you buy a property for $100,000, you really want to make sure it brings in at least $1,000 a month in rent. Hitting that 1% mark helps guarantee the property generates enough passive income to safely cover the mortgage, the insurance, and, those inevitable late-night plumbing disasters.
All right, Section 3, liquid assets, the stock market. Stepping over into the other corner of our matchup, we're looking at the highly fluid, fast-paced side of wealth accumulation.
Now, stocks offer a completely different vibe. For starters, they require significantly less initial capital to get going, and they provide incredible liquidity. What does that mean for you? It means you can cash out with the literal click of a button on your phone if you ever need your funds in a pinch. You can also effortlessly diversify by buying tiny fractional shares in companies spread across dozens of global industries. Oh, and you can supercharge all that growth through tax-advantaged retirement accounts like your standard 401k or IRA.
But, and there's always a but, the major trade-off here is this serious emotional labor. The stock market is prone to extreme short-term price volatility. Economic shifts, interest rate hikes, geopolitical drama, all of this can cause rapid, honestly terrifying price swings. And that frequently triggers one of the absolute biggest dangers to any investor, panic selling, straight from your smartphone. Plus, if you end up selling outside of a retirement account, boom, you instantly trigger capital gains taxes, which takes a massive, painful bite right out of your profits.
So really, this fundamental choice comes down to your own personal preference between two very distinct types of stress. Are you more comfortable with the physical stress of managing a tangible asset, coordinating endless repairs, and dealing with illiquidity? Or would you prefer the emotional stress of watching a highly volatile digital market jump up and down every single day, requiring absolute Zen-like discipline to just not panic sell?
That brings us to Section 4, the hybrid option, REITs. Because hey, if neither of those extremes sounds appealing to you, let's explore a really fascinating wildcard alternative.
Enter REITs, or real estate investment trusts. These are companies that own, operate, or finance income-producing real estate. But what makes them so incredibly special is that they trade exactly like regular stocks. This means REITs let you invest in a highly diversified portfolio of physical real estate. Think commercial office buildings, massive apartment complexes, or even medical facilities, without ever having to fix a single toilet, chase down a late rent check, or manage a tenant yourself. It's kind of the best of both worlds.
Moving on to Section 5, the historical return showdown. Let's put these asset classes in the ring together and look at the cold, hard data. So what actually has the higher historical return? Now, when we look back at history, it's really important to remember that both of these markets have taken massive, bruising hits during events like the 2008 Great Recession and the 2020 COVID-19 crisis. But when we zoom out and put their long-term growth rates side by side, the data paints a surprisingly clear statistical picture.
Looking at the broad market reality from 1992 to 2024, the stock market, represented here by the S&P 500, actually comfortably outpaced the physical housing market. The S&P 500 returned a really solid 8.27% annually over that period. Meanwhile, the U.S. housing market averaged roughly a 5.5% annual growth rate. So stocks take the point there.
Yet, get ready for a massive twist. Historically, if we stretch the timeline back from 1972 all the way up to 2023, our wildcard option, equity REITs, actually outperformed both traditional real estate and the broader stock market. Yeah, yielding an incredibly impressive 12.7% average annual return. How wild is that?
But hold on, you can't just look at raw returns in a vacuum. You absolutely have to factor in taxes. When you sell stocks outside of those retirement accounts we talked about, capital gains taxes just chew through your earnings. That is exactly why stock investors rely so heavily on 401ks and IRAs to shelter their wealth. Real estate investors, on the other hand, have this unique tool called a 1031 exchange. It literally lets them take the profits from selling one property and roll it directly into a new property, completely deferring their capital gains taxes in the process. It's a huge strategic advantage.
Finally, Section 6, which is better for you? As we wrap up this explainer, we really need to distill all this complex data down into a practical takeaway for your own portfolio.
The honest truth is, neither asset is universally better than the other. The sources make it crystal clear. Your choice simply dictates your day-to-day strategy. You just have to decide whether you'd prefer to leverage bank debt for a stable, labor-intensive physical property, or if you'd rather leverage high liquidity for a volatile, completely hands-off digital asset.
So as you map out your own investing journey, ask yourself not just what percentage of returns you want to earn, but what kind of stress are you realistically willing to live with to secure your financial future? Are you a landlord in the making or a cool-headed stock market strategist? Have a real think on that. Until next time, keep learning, keep growing, and keep building your future.